Did you know that a surge in new multifamily units and an ongoing trade war with the United States is shaking up the Canadian housing market? Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. The Canadian multifamily market is currently navigating a unique set of challenges, as reported by CoStar on November 10, 2025. According to a report from Oxford Economics, the market is under pressure from a combination of factors, including a significant influx of new apartment supply and trade tensions with the United States. The report highlights that Canada's national average asking rent stood at $2,129 per month in May, marking a decline of 3.3% compared to the same month last year. Cities like Calgary, Vancouver, and Toronto have seen the most pronounced drops in apartment rents over the past year. The completion of new multifamily units jumped by 35% in 2024, rapidly increasing the housing supply across the country. Oxford Economics anticipates that this trend will persist as a record number of purpose-built rental units are completed and absorbed into the market. However, the demand side is experiencing some headwinds, with slower immigration and fewer temporary residents expected to dampen rental demand. Despite these challenges, the report suggests that worsening homeownership affordability and financial strain on households during the trade war-induced recession may keep a floor under rental demand in the coming quarters. On the international stage, tensions have been high as United States President Donald Trump has threatened to escalate the trade war with Canada over tariffs unless the Canadian government rescinds its digital service tax. This tax targets U.S. tech giants with billions of dollars in taxes. In response, Canadian Prime Minister Mark Carney's government has agreed to resume negotiations, with both parties aiming to reach a deal by July 21st. However, the outcome remains uncertain. Tony Stillo, Director of Canadian Economics at Oxford Economics, has weighed in on the situation, projecting that unless an immediate deal is reached to remove most U.S.-Canada tariffs, the housing slump could persist through the end of 2025. He expects the resale housing market recovery to stall due to poor affordability, weak consumer confidence, and job losses stemming from the likely ongoing recession. A shrinking population, resulting from immigration cuts, is also expected to impact the sector by increasing the supply of homes for sale and potentially causing average prices to drop by 8 to 10% by year's end. CoStar Market Analytics also offers insights into the multifamily market, noting a rebalancing as market vacancy rates approach more balanced levels in highly unaffordable urban areas like Toronto and Vancouver. Meanwhile, Alberta is experiencing vacancy rates moving towards cyclical highs. As always, these challenges present opportunities for savvy investors to navigate the market dynamics and find promising investments, particularly in multifamily properties. Morgan Properties, a major player in the apartment sector based just outside Philadelphia, has announced its agreement to acquire Toronto-based Dream Residential Real Estate Investment Trust. This acquisition will allow Morgan Properties to incorporate Dream Residential's holdings, which are primarily located in the United States Midwest and the rapidly expanding Sunbelt region. According to CoStar News, Dream Residential values this all-cash purchase offer at approximately $354 million United States dollars. This move concludes Dream Residential REIT's strategic review, and unit holders are expected to receive $10.80 per unit, reflecting an 18% premium over the REIT's closing price on the previous Wednesday. The sale is anticipated to close later this year, pending stakeholder approval. This acquisition is set to expand Morgan Properties' already substantial portfolio, which predominantly consists of apartments in states like New York and Pennsylvania. By acquiring Dream Residential, Morgan Properties will strengthen its presence in high-growth areas, including Texas, and enhance its holdings in the Midwest, where rent growth has been reported to outpace other regions in the United States. CoStar Group's Apartments.com notes that the Midwest has seen a notable rent growth that surpasses the rest of the country, a trend that Morgan Properties aims to capitalize on. Dream Residential, which launched 3 years ago, manages a portfolio of 15 properties totaling approximately 3,300 units. These consist mostly of garden-style apartment complexes in metropolitan areas such as Dallas-Fort Worth, Oklahoma City, and Cincinnati. Under the leadership of Chief Executive Officer Brian Pauls, since June 2023, the REIT has carved out a significant niche in these markets. Morgan Properties, ranked as the third largest apartment owner in the United States by the National Multifamily Housing Council's 2025 Top Owners list, is poised to integrate these assets into its extensive portfolio, which currently spans over 100,000 units across more than 360 municipalities in 22 states. The acquisition will also mark the termination of Dream Residential's service agreements with Dream Unlimited and Paul's Corporation. To cover outstanding fees and wind down costs, Dream Residential will make a separation payment of $7 million United States dollars. Jonathan and Jason Morgan, serving as co-presidents of Morgan Properties, will oversee the integration of these new assets into their company's operations, continuing the legacy established by their father, Mitchell Morgan, who founded the company in 1985. Morgan Properties is headquartered in Conshohocken, Pennsylvania, with an additional office in Rochester, New York. Now let's shift gears and dive into the Canada housing market forecast for 2025 and 2026, as outlined by Marco Santarelli on November 9, 2025. According to Santarelli, the Canadian housing market is expected to experience a mixed bag in 2025, with a noticeable rebound anticipated for 2026. While 2025 might see a slight dip in sales and a modest price adjustment, the underlying strength suggests a strong comeback is on the horizon. As we look at 2025, the Canadian Real Estate Association anticipates a slight softening in the resale housing market, projecting around 473,090 residential properties to trade hands across Canada. This represents a modest decrease of 1.1% compared to 2024. Santarelli points out that tariff chaos and economic uncertainty earlier in the year caused many potential buyers to pause, impacting markets like British Columbia and Ontario. These provinces, known for their higher price points, can create a ripple effect across the entire country. On the price front, the national average home price is forecasted to see a slight decline of 1.4%, bringing it to an estimated $676,705. This decline is largely influenced by price adjustments in British Columbia and Ontario. However, Santarelli notes that many other provinces are expected to see price gains ranging from 4 to 8% in 2025. This suggests that while some expensive markets might cool down a bit, affordability challenges and price growth could still be a concern in other areas. Now looking ahead to 2026, CREA's projections paint a much rosier picture. National home sales are forecast to rebound significantly, with an estimated 509,479 properties trading hands. This represents a robust increase of 7.7% from 2025. Santarelli emphasizes that this level of activity is the highest seen since 2021, though still below the absolute peak reached historically. On the price front, the national average home price is expected to climb by 3.2% from its 2025 level, reaching an estimated $698,622. This projection marks the sixth consecutive year where the average price hovers around the $700,000 mark, indicating a period of relative stability for the national average, punctuated by moderate growth. For potential buyers, the 2025 forecast might offer a slight reprieve in some pricier markets, potentially creating windows of opportunity. However, with competition expected to heat up by 2026, it's wise to be prepared. For sellers, understanding these trends is vital. The strong rebound anticipated for 2026 suggests that holding on might lead to a better return if you're not in a rush. For investors, Santarelli highlights the regional variations as key. Provinces showing consistent growth in both sales and prices, like Quebec and Manitoba, might present attractive opportunities. Diversification remains a smart strategy, and staying informed is crucial. As always, these forecasts are based on current data and trends, and unexpected economic shifts or global events can influence the market. It's essential to stay informed and consult with local real estate professionals to make decisions that align with your personal financial goals. Thank you for tuning in to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.